Margaret spent 28 years as a hospital administrator. She managed budgets in the tens of millions. She understood compliance. She understood documentation. She understood what happened when paperwork was late. She retired in September of 2025 feeling completely prepared. She had savings, she had a pension, she had her Medicare card. What she did not have was any idea that 5 specific IRS documents had new filing requirements taking effect in 2026. By March of 2026, she had received 2 penalty notices totaling $840. She had not hidden income. She had not made errors on her return. She had simply never filed certain forms that, as an employee, her employer had always filed on her behalf. The moment she retired, those obligations transferred to her. Nobody told her. The IRS does not send a memo when the rules change. It sends a penalty notice after you miss them. Today, I am going to walk you through 5 specific documents that the IRS now requires from retirees in 2026, and the penalties attached to each one when they are missed. These are not new tax concepts. They are existing IRS obligations that apply to retirement income in ways most retirees have never encountered before, because their employer handled them automatically for decades. The moment that automatic system stopped, the obligation did not disappear. It transferred to you. And the IRS began enforcing these 5 areas with significantly increased scrutiny starting in 2026, as the largest wave of baby boomer retirements in history pushed millions of new retirees into a tax system they were not ready for. Every one of these 5 documents has a specific form number, a specific deadline, and a specific penalty calculation. By the end of this video, you will know exactly which ones apply to you, what the penalty is if you miss them, and precisely how to fix the situation before it gets worse. The first document the IRS is penalizing retirees for missing is Form 5329. Most retirees have never heard of Form 5329. That is exactly why it is the #1 source of IRS penalty notices for new retirees in 2026. Form 5329 is the additional taxes on qualified plans form. It serves 2 completely opposite purposes depending on your situation. It either reports the 10% early withdrawal penalty you owe on a retirement account distribution, or it reports an exception that eliminates that penalty. It also reports the excise tax when you fail to take a required minimum distribution on time. Here is where retirees get hit. If you take a distribution from a traditional IRA or 401k before age 59 and a half, and you qualify for one of the IRS exceptions to the 10% penalty, you must file Form 5329 to claim that exception. If you do not file it, the IRS automatically applies the 10% penalty based on the distribution code on your 1099-R. The IRS sees a code 1 in box 7 of your 1099-R. That code means early distribution without exception. The IRS does not ask questions, it assesses the penalty. If you believe an exception applies, the burden is on you to file Form 5329 and say so. The 10 exceptions that eliminate the early withdrawal penalty include distributions taken due to total and permanent disability, distributions taken by someone who separates from service at age 55 or older in the year of separation, distributions taken as part of substantially equal periodic payments under IRS Rule 72T, distributions made directly to the IRS to pay a tax levy, and distributions taken for qualified unreimbursed medical expenses above a certain threshold. In 2026, that medical expense threshold is 7.5% of your adjusted gross income. If your qualifying medical expenses exceeded that amount and you took an IRA distribution to cover them, the penalty exception applies and Form 5329 is how you claim it. The penalty for not filing Form 5329 when it is required is not trivial. For a retiree who took a $30,000 early IRA distribution and failed to file Form 5329 to claim a valid exception, the IRS can assess a $3,000 penalty that was never owed. That penalty accrues interest from the original filing deadline. If the return was filed in April and the penalty is not addressed until August, the interest compounds at the federal underpayment rate, which is 7% for the first quarter of 2026. The fix for a missed Form 5329 is straightforward. File the form as a standalone document with a signed cover letter explaining the exception being claimed. Attach documentation supporting the exception. The IRS will generally abate the penalty if the exception is clearly established. But you must act. The IRS does not correct this on your behalf. The second document the IRS is penalizing retirees for missing is Form 8606. Form 8606 is the non-deductible IRA form. If you ever made a non-deductible contribution to a traditional IRA, meaning a contribution you did not take a deduction for on your tax return, those contributions are after-tax dollars. When you take a distribution from that IRA in retirement, a portion of each distribution is a return of your own after-tax money and is not taxable again. Form 8606 is how you track the basis in your IRA and calculate the non-taxable portion of each distribution. The problem is that many retirees made non-deductible IRA contributions years or even decades ago and have no memory of filing Form 8606 at the time. Some did not file it when they should have. Some did, but the records are lost. When they begin taking distributions in retirement and report the entire amount as taxable, they are overpaying their taxes. When they try to report only the taxable portion without having filed Form 8606, or without having a record of their cumulative basis, the IRS flags the discrepancy. The penalty for not filing Form 8606 when required is $50 per failure. That sounds modest, but each year you failed to file it when non-deductible contributions were made counts as a separate failure. A retiree who made non-deductible IRA contributions for 12 years without filing Form 8606 each year faces a potential $600 in penalties before any interest calculation. And more expensive than the penalties is the tax cost of reporting distributions as fully taxable when a portion was already taxed. In 2026, the IRS increased matching of Form 1099-R distributions against prior Form 8606 filings. If you begin taking distributions and report a non-taxable portion on line 4B of Form 1040, the IRS cross-checks whether your Form 8606 history supports that claim. If it does not find consistent Form 8606 filings in your history, you will receive a CP 2000 notice. The fix involves reconstructing your IRA basis by gathering all prior tax returns where non-deductible contributions were made and filing late Form 8606 filings for each year. The late filing fee is $50 per year, but you can request a waiver by writing a letter showing reasonable cause. More importantly, once the basis is established on record, your future distributions are correctly split between taxable and non-taxable amounts, and you stop overpaying. Sandra is 68 years old. She contributed the maximum non-deductible amount to her IRA for 9 years in the mid-2000s when her income was too high for deductible contributions. Total non-deductible contributions, $27,000. She never filed Form 8606 for any of those years. When she started taking $24,000 per year from her IRA in retirement, she reported the entire amount as taxable income. She overpaid her federal taxes by approximately $1,800 per year because she was paying ordinary income tax on money she had already paid tax on. Over 5 years of retirement distributions, that is $9,000 in excess taxes paid, entirely because a form was never filed. The third document the IRS is penalizing retirees for missing is the FBAR, officially called FinCEN Form 114. This one surprises retirees the most because it is not even an IRS form. It is filed with the Financial Crimes Enforcement Network, but the IRS enforces it and the penalties are severe. If you have a financial interest in or signature authority over foreign financial accounts, including foreign bank accounts, brokerage accounts, or pension accounts, and the total value of those accounts exceeded $10,000 at any point during the calendar year, you are required to file the FBR by April 15th each year with an automatic extension to October 15th. Retirees are increasingly affected by this requirement because of foreign pensions, overseas investment accounts held during working years abroad, and retirement accounts in countries where they previously worked. A Canadian registered retirement savings plan, a UK pension, or an Australian superannuation account each triggers the FBAR requirement if the value exceeded $10,000 at any point during the year. The penalty for a non-willful FBAR violation, meaning you simply did not know the requirement existed, is up to $10,000 per account per year under current IRS enforcement guidelines. For willful violations, the penalties escalate dramatically. The IRS and FinCEN have pursued FBAR penalties aggressively since 2010, and the 2026 enforcement focus includes retirees with foreign pension assets they have never reported. The fix for a missed FBR is to use the IRS Streamlined Filing Compliance Procedures. This program allows taxpayers who missed FBAR filings due to non-willful conduct to come into compliance by filing amended returns and FBRs for the most recent 3 years, paying any back taxes owed, and paying a 5% miscellaneous offshore penalty on the highest aggregate foreign account balance. This is dramatically less than the full non-willful penalty, but you must act before the IRS contacts you. Once an examination or investigation begins, the streamlined program is no longer available. David is 71 years old. He worked in Germany for 6 years in his 40s. He maintained a German bank account with retirement savings throughout that period. He rolled most of it to a US IRA when he returned, but kept approximately $18,000 in the German account as an emergency cushion. He never filed an FBAR. He never knew he had to. In 2026, the IRS issued a notice based on information sharing under the Foreign Account Tax Compliance Act. His non-willful penalty exposure was up to $10,000 per year for 6 years. He used the streamlined procedures, paid the 5% miscellaneous penalty on his highest balance, and resolved the matter. But the process took 8 months and cost him $4,200 in professional fees on top of the penalty. If this is helping you understand what you need to set up correctly before your first full retirement tax year, hit the like button right now and share this with any retiree you know who is heading into their first year without a paycheck. Subscribe and turn on the bell so you never miss a video like this one. The fourth document the IRS is penalizing retirees for missing is Form 1040-ES. This surprises retirees because Form 1040-ES is not a form you file with your annual return. It is the estimated tax payment voucher, and the penalty is not for missing the form itself. The penalty is for failing to make the quarterly estimated tax payments that retirees with income from pensions, IRA distributions, Social Security, dividends, capital gains, and self-employment are required to make throughout the year. As an employee, your employer withheld federal income tax from every paycheck and remitted it to the IRS throughout the year. In retirement, nobody does that automatically. If you do not set up withholding on your pension, your Social Security, your IRA distributions, or if you have investment income with no withholding at all, you are responsible for making 4 quarterly estimated tax payments using Form 1040-Es. The IRS Safe Harbor rule for 2026 works as follows. You will not owe an underpayment penalty if your total withholding and estimated payments for the year equal at least 90% of your 2026 tax liability, or if they equal 100% of your 2025 tax liability. If your 2025 adjusted gross income was above $150,000, that threshold rises to 110% of your 2025 liability. The 4 estimated tax deadlines for 2026 are April 15th for the first quarter, June 15th for the second quarter, September 15th for the third quarter, and January 15th of 2027 for the fourth quarter. The IRS calculates the underpayment penalty separately for each quarter. A retiree who pays everything in December owes penalties for the first 3 quarters, even if the annual total is correct. The underpayment penalty rate for the first quarter of 2026 is 7% annualized. For the second quarter, it is 6% annualized. These rates are set quarterly by the IRS based on the federal short-term rate plus 3 percentage points. A retiree who underpays by $12,000 across the first 3 quarters of 2026 can expect an underpayment penalty in the range of $500 to $600. That is not a catastrophic number, but it arrives on top of the unexpected tax bill itself, and for a retiree on a fixed income, the combination produces serious financial stress. Patricia is 67 years old. She retired in January 2026. Her income for the year is $22,000 from Social Security, $30,000 from a pension, and $15,000 she took from her IRA for a home repair. She set up no withholding anywhere. Her total 2026 federal tax liability is approximately $8,400. She made no estimated payments during the year. In April of 2027, she owed $8,400 plus an underpayment penalty of $410 calculated across the 3 quarters she had been under withheld. Patricia did not commit fraud. She made no errors. She simply did not know the withholding system had become her responsibility the moment she retired. The fix starting today is to contact your pension administrator and file Form W4P to set withholding at a rate that covers your expected liability. Contact the Social Security Administration and file Form W4V to request federal withholding at 7, 10, 12, or 22% of your benefit. For IRA distributions, request withholding each time you take a distribution. If your income from any source is irregular or unpredictable, calculate your estimated liability using the prior year's safe harbor and divide by 4. Send those payments quarterly using Form 1040-ES before each deadline. The 5th document the IRS is penalizing retirees for missing is Form 8960. Form 8960 is the net investment income tax form. It is a separate calculation that applies to higher income retirees whose modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples filing jointly. The net investment income tax is 3.8% applied to the lesser of your net investment income, or the amount your modified AGI exceeds the threshold. Net investment income includes interest, dividends, capital gains, rental income, royalties, and passive business income. It does not include Social Security, pension distributions, or IRA withdrawals. But here is where retirees run into trouble. A retiree who has a pension, Social Security, and begins drawing down a substantial investment portfolio can cross the $200,000 threshold without realizing it. And when capital gains from selling long-held investments get added on top, the net investment income tax applies to a significant portion of those gains. Form 8960 must be attached to your Form 1040 when the tax applies. If you cross the threshold and do not file Form 8960, the IRS will identify the discrepancy when it compares your income level against your return and issue a CP 2000 notice proposing additional tax plus interest from the original filing date. The IRS cross-references Form 1099 Div and Form 1099B amounts against this threshold automatically. The penalty situation with Form 8960 is not a standalone late filing penalty. The penalty comes from underpayment. If you owed net investment income tax and did not include it in your estimated payments or withholding throughout the year, the underpayment penalty applies to that shortfall the same way it applies to any other unpaid tax. Richard is 72 years old. His retirement income is $48,000 in pension income, $28,000 in Social Security, and $40,000 in IRA distributions. His modified AGI is $116,000, no net investment income tax. But in 2026, Richard sells a stock position he has held since 1998. The gain is $95,000. His modified AGI for the year becomes $211,000. He crosses the $200,000 threshold by $11,000. His net investment income from that sale and from $18,000 in dividends totals $113,000. The 3.8% net investment income tax applies to $11,000, the amount he exceeded the threshold. His additional tax is $418. Richard had no idea this form existed. He filed his return without it. He received a CP 2000 notice 6 months later proposing $418 in additional tax plus $29 in interest. He paid it. But had he planned the stock sale to stay below the threshold, he could have avoided it entirely. Here is your action checklist for every one of these 5 documents. For Form 5329, pull every 1099-R you received for the current tax year. Review box 7 on each form. If the distribution code is 1 and you believe a penalty exception applies, you must file Form 5329 with your return and attached documentation. Do not assume the custodian will handle this. They will not. For Form 8606, go back through your records and identify every year you made a non-deductible IRA contribution. If you cannot find Form 8606 filings for those years, contact a tax professional about filing the missing forms and establishing your IRA basis before you begin distributions or before you file the return that includes distributions. For the FBAR, ask yourself one question right now. Do you have or have you ever had a financial account in a foreign country? If the answer is yes, and the balance ever exceeded $10,000 in any calendar year, you may have an FBR obligation. The FBR is filed electronically through the BSA e-filing system at bsafiling.finson.trias.gov, not through the IRS website. The deadline is April 15th with an automatic extension to October 15th. For Form 1040-ES, look at last year's tax return. Find line 24, which shows your total tax. Make sure your combined withholding and estimated payments for 2026 will equal at least that amount. If you are behind, the remaining quarters still give you the opportunity to catch up. You cannot retroactively fix the quarters you already missed, but you can prevent the shortfall from growing. For Form 8960, before you sell any investment in retirement, add the projected gain to your current year income and check whether the total will exceed $200,000 single or $250,000 married. If it will, calculate the net investment income tax using Form 8960 and include that amount in your estimated tax payments for the quarter in which the sale occurs. There is a thread connecting all 5 of these documents that is worth naming precisely. Every single one of them exists because retirement income comes from more sources, more account types, and more jurisdictions than employment income did. Your employer had a compliance department, they had payroll software, they had a legal obligation to get this right and face consequences if they did not. You have none of those things now. What you have is the same obligation they had, transferred to you without training and without a welcome packet.